right, cool. So here we go. This is a practice exam with 75 questions on learning mode. We have to get a you have to be getting like on learning mode is a good way to study because as you read and you try to answer the question, whether you get it right or wrong, by the way, you could take this unlimited times, and whether you get it right or wrong is going to tell you with a rationale, which is how you learn. That's why it's called learning mode. So right here it says the practice of insurance for each exposure unit is called as
The
rate.
price. The price. So would it be? Oh, that would. Okay, that
Rate is like
rate.
what, like look at it
The
like
price.
this. Hey, can you give me some insurance rates? Quotes, rates,
Okay.
quotes, rates. It's kind of like the same thing, right? Sometimes people ask, hey, what are your rates? What are your rates?
Oh,
So,
okay then.
and then right here, you can see the beauty of this, right? Rate is a price of insurance for each exposure unit. The rate helps determine the premium by multiplying the number of units of insurance purchase. So yeah,
Oh,
so the
okay.
price is a rate. All right, fixed annuities provide all of the following except fixed annuities,
Future.
minimum guarantee interest rate, yes. Future income payments, yes. Hedge against inflation, no. So fixed annuities don't beat inflation. So the interest rate is guaranteed, but is really low. That's why it's guaranteed because there's not a lot of risk. Actually, there's no risk because it's fixed. So therefore, you're not going to beat inflation, and that's what hedge against inflation means. Okay. So right here's fixed annuities, investment premiums, payments into a general account, a safe and conservative investment portfolio. They also provide a specific dollar amount for each annuity payment, regardless of the purchasing power of the money. Variable annuities premiums are invested in securities. See that? So variable annuities, they're invested in securities. Securities meaning investments that vary. It ranges. There's risk involved. It goes up and down. It's not fixed. Hopefully maintaining constant purchasing power and therefore providing protection against inflation or hedge against inflation. They're the same thing. Protects you against inflation. Any questions?
Against. Against. That's a good one to put against. Against.
Yeah, against.
To
Hedge
remember.
against is the same thing. Yeah, so you could
Fixed
remember.
annuities against. Yeah. All right. Cool.
No, no, no. Fixed annuities are not a hedge against inflation.
Oh, it's not.
It's
Okay.
not because it's fixed, so it's very low, and it's probably inflation is going to be higher than the interest rate that you get. Okay, so don't get it confused. And by the way, if you're able to screenshot like right there, this right here, then that would be to your benefit because you could review. In fact, I would like you to do that so that you could paste them in our private chat room that we have, the life exam prep class. We had another
Wow.
person that did it. That worked out really good. All right, let's go to the next one. When a replacement carrier has has a question regarding the prior carrier's coverage, from which of the following can they demand a clarification? The employer, the servicing agent, the prior carrier, the Department of Insurance. This is a new question for me, so I'm gonna go with the prior carrier. Let's see what happens. Yep, common sense, right? Section whatever of the CIC requires a prior carrier to provide clarification. Okay, that one's just common sense, right? A domestic insurer issuing variable contracts must establish one or more separate accounts. So right here, the keyword is variable. Variable contracts, separate account. Variable contract, separate account. If it's not variable, then it's going to be general account. But because it says variable, it's separate account. There's a rationale. Screenshot that. All right. Most agents try to collect initial premiums from for submission with the application. When an agent collects the initial premium from the applicant, the agent should issue the applicant a premium submission application. When the agent collects an initial premium from the applicant, the agent should issue the applicant a warranty Premium receipt, backdated premium, statement of good health. I'm gonna go
D.
with statement of good health. Premium receipt.
Oh,
Ooh.
premium receipt. We're collecting finishing.
Yeah, okay. Now that we read it, it's like, well, yeah, duh, right? A prospective insured receives a conditional receipt but dies before the policy is issued. The insurer will but receives a conditional receipt. So yeah, pay the policy premiums and establish up to the established limit, not pay automatically pay the policy proceeds. Pay the policy proceeds if and only would have issued the policy. Yes. That's the right answer. See that C also looks good, but the right answer is A. If if it would have issued the policy. Make sense?
Oh, huh.
See that?
Yeah.
So just because you have a conditional receipt doesn't mean that if you die, it's gonna pay, it's gonna cover. No, the policy it's gonna pay, assuming that the policy would have been issued anyways.
Oh, okay.
So there's an assumption right there.
Yeah.
Next one. If a beneficiary is not named for annuity benefits, to which entity will the benefit be paid?
D. Oh, the duty.
It's gonna go to the estate account, the annuitant's estate.
Oh,
Ahí
okay.
está. So again, if there's no beneficiary, not just in annuities, in life insurance, in anything, if there's no beneficiary, the money goes to the estate.
Okay.
Aquí en este caso it says the annuitant's estate. It could be the person's estate, just or to their estate, to the family's estate, to the person's estate. It's the same thing.
Okay.
Okay, not all losses are insurable, and there are certain requirements that must be met before a risk is a proper subject for insurance. These requirements include all of the following except
D.
loss must not be catastrophic, must be intentional,
Oh,
not be intentional. So this is
oh,
this is all of the following are included except.
oh, except. Ah,
So in the test, that's one of the things that you gotta make sure that you read the question twice because sometimes you answer questions incorrectly just because you didn't read the question right.
yeah.
The insurer loss, right? So the loss may be intentional, it cannot be intentional. This is good because it hits on all the points of what is insurable.
Sure.
All of the following actions by a person could be described as risk avoidance except avoiding, never flying, refusing, investing in the stock market. Yeah, that's not
This
a.
one always gets me.
Yeah, if you invest in the stock market, you're not avoiding it. You're literally in the game, in the risk.
Yeah.
Which of the following best defines an insurance policy? A contract. So when you get a question like this, just know that an insurance policy is a contract. So you see, this one doesn't have contract. This one doesn't have contract. Doesn't have contract. So it's a contract. A fee charged to the insured with when a policy or annuity is exchanged for its cash value is charged to the insured when a policy or annuity is exchanged for its cash value.
Third card.
Yeah, it's a surrender charge.
Oh, surrender.
Yeah. Yeah, surrender charge is when you cancel a policy early. This works for life insurance too, so this is good to know. Surrender charge is very important to know because that comes out in types of policies and it comes out in annuity questions. So it's something that you could really benefit from this right here, knowing what a surrender charge is. When the breadwinner that is insured by a family policy dies, what rights are provided to other family members that are covered under the policy? Policy members not providing rights. They are surrender coverage. They can convert their coverage. They convert their coverage permanent life insurance with evidence of. I think it's C. Let's see. Yeah, there it
So
is.
close together. Without and with.
It's
By
without.
one
Yeah.
word. Yeah.
So
So
they could
family.
convert their policy without showing that they're healthy, without evidence of insurance.
Oh, okay. Without. All right.
Which of following policies would be classified as a traditional level premium contract? Variable, straight life. So straight life has a level premium. Universal life is flexible premium. Adjustable life has flexible premium. Variable universal life is a flexible premium too. Straight life is the only one that has level guaranteed face amount and level premiums for the life of the insured. But not for the life, it's till age 100, which pretty much is for the life. Which of the following is true regarding a market value adjusted annuity? All right, so this one is the owner is guaranteed a fixed interest rate for a specific period of time.
Time. That's right.
Okay, so screenshot that. Market value adjusted annuity, modified guaranteed annuity. Okay, next one. During the free look period, the premium for a variable annuity may be invested in all of the following except during the free look period in value funds. It can be invested in stock in the stock market. It has to be in something conservative, something calmadito, something nothing crazy.
Uh,
So like fixed income, that's fixed, right? So there's no so the client the insurance company can't lose money. Money market funds, mutual funds, only upon the investor's request, right? So it can be invested in mutual funds, like value funds, but the reason this one is not the right answer is because this one the investor gave permission to do it.
so it's 30 days for that
Free look
free look.
free look period is 10 days, but it's 30
Oh,
days for seniors, 30 days for people that are 60 years
oh,
old.
for seniors. That's the one that got me because
Yeah.
I thought it was 10 days too, but the senior one got me in 30 days. Okay.
Yeah, that's California
That's the
test.
one on the
Not.
test. That's the one on the test I got wrong for the 10 days
Oh,
to the 30 days for
there it is.
seniors.
Yep. Yep, there it is. So that's what you want to look into, right? All right, next one. An annuity owner is finding an annuity that will supplement her retirement because she does not know what the effects of inflation may have on her retirement dollars. She would like a return that will equal the performance of the Standard and Poor's. She likes to purchase a equity index annuity. So whenever you see S&P 500 index, it's called an equity index annuity. So that's the little trick right there.
Connection.
Yeah. Any insurer who engages in the insurance business and violates the code with respect to insurance replacement shall in the first violation. So this is the insurer, this is the insurance company, $10,000. And on the repeat violation would be $30,000. But on the first violation is $10,000. Yeah.
Oh,
In an adjustable life policy, all of the following can be changed by the policy owner except the premium, the amount, the type of investments, legal coverage. Mm.
the adjust.
I think it's that one. Ah, it's a type of investment. Okay. Go ahead and screenshot that. I got it wrong. Which of the following is not a characteristics of pure risk? Pure risk. The loss
Not
the loss exposure must be large, the loss must be measurable, the loss must be catastrophic. Cannot be
catastrophic.
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 Yeah.
That one I know.
It must not be catastrophic.
Yep.
Which non-forfeiture option has the highest amount of insurance protection? The extended term. Extended term is the highest. So there's only two non-forfeiture options, extended term and reduced paid up. These are the only two. So
Okay.
question, answer A, M, D, and C are just bogus answers.
Yeah.
There's only two types of ¿cómo se llama? Non-forfeiture options. Harry has just received his life insurance policy and reviewed the title page. Harry was able to ascertain information the following except beneficiary. I hear. So the cover page doesn't show beneficiaries. Okay. So that's the answer. You'll never see beneficiaries on the cover page. Hazard is best defined as the something that increases the chances of loss. Screenshot that. A person applying for insurance license in California was previously found guilty in a trial in which he entitled a plea or no solo contender. What does no solo contender mean? Um, Not guilty by reason of circumstance. Guilty, but with justification without reason. No contest. No contest. Screenshot that. Okay. Let's go to the next one. An insured pays an annual premiums to his insurer. In return, the insurer promises to pay. This is consideration almost good. This is um consideration. Yeah, I was about to get it wrong. Screenshot that. All right, I'm actually gonna post up right now the on the chat. Um, Whoever wants to jump into our study right now. So
Go for it. Go for
so
it.
I don't know if you're part of the chat.
Yeah.
You
Of
are?
the life insurance studies.
Yeah.
Yeah. Yeah, it's been a while since you post something, so we need to post something up there.
Okay, there it is. There it is. Yeah. The last time I posted something was December 30th. What are you talking about?
Telling you,
Wow, you want daily stuff, huh? Daily fresh.
hey,
I don't know.
we got to put something out fresh for the new recruits that come out.
Yeah, yeah. You're right, you're right, you're right. All right, there it is. Okay. At the time the insured purchase, by the way, if you're watching this video on YouTube, you want to be part of the chat, just click on the link on the description of this video. All right, that was my little plug for the day. At the time of the insured purchase her life insurance policy, she added a rider that will allow her to purchase additional insurance in the future without having to prove insurability. This rider is a waiver of cost of insurance. No, it's a guaranteed insurability rider. There it is. So remember I was talking about riders? Riders, I was telling you that riders are sweeteners. Riders are additional benefits to what's already there, to the general insurance coverage. It costs a little bit more money. Riders, when you add a rider to a policy, usually the cost goes up. There's an extra cost for it. Okay.
Yeah.
All right. So there it is. Waiver of cost of insurance is also a rider. Okay. This one is that the payments stayed low, and then the cost of living, and then the accelerated benefits. Accelerated benefits that is a rider that if you become terminally ill, the company gives you some of the face amount while you're still alive to pay for medical expenses or whatever. The cost of living rider is a rider that the coverage goes up every year to keep up with inflation. Okay. And obviously, when the coverage goes up, the payment goes up a little bit too. But that's how the rider works. The rider, some people want more coverage as time is passing by. So that's what that benefit does. All right, let's keep going. How is the premium in an insurance policy determined? Um, Multiplying the rate by the units of insurance. That was the first question that we went through, right? What is rate?
Yeah. Yep.
All right, let's keep going. What is the penalty for IRA distributions that are below the required minimum for the year? Below the required minimum, I think it's 50%. It's a pretty
Thought it
nasty
was
one. Okay.
25.
Yep, you're
Uh,
right. It is 25. Okay, screenshot that. All right, which statement is not true regarding a straight life policy. It usually develops cash value by the third year. Yes. A face amount of policies paid to age 100. Yes. Its premiums steadily decrease over time. No, the premiums stay fixed. That's the answer. You see that? Straight life is another name for straight life that they're using the test is whole life
Or like
or pure life. There's three of them. Okay, so it sucks, I know, but
universal.
no, not universal. That's a whole different
Oh,
type of policy. So
oh,
whole life, straight life, and pure life are the same thing. They're synonyms. Okay,
okay.
they're talking about the same type of policy, which is generally they call it whole life insurance. But sometimes
Okay.
they call it like here they call it straight life is the same thing as whole life. Whole life premiums are fixed, right? So that's why C is wrong. It has the lowest premium amount in three types of whole life policies. There it is. See that? It's a type of whole life. All right, let's keep going. Which of following statements is true concerning the accidental death rider? The rider is only available to insureds over the age of 65. It also known as triple indemnity. That's true. It will pay double and triple the face amount. It is only available in group insurance. I think it's either B or C, but let's go with C. Yeah, there it is.
There you
Screenshot
go.
that. Right. So triple face amount, triple indemnity is the same thing, but C was a better answer, right? Because it pays double or triple depending on if it's double indemnity or triple indemnity. See that? So the answer is there too. So this one's tricky, but the best answer is C.
Multiple. Yeah.
What is a factor? What is the focus of fraud division with the enforcement branch? Oh gosh, fraud against broker, fraud committed against elderly. I would like that against the consumer, against the insurers. Let me see.
Super, no?
Oh no, it's the
Oh,
insurer.
wow.
So fraud is to protect from people taking money from the insurance company. So
Oh,
it's fraud
oh,
committed
wow.
against the insurers. Yeah, crazy.
Oh, wow.
Yeah, you would think it protects the elderly, right?
Yeah.
Which of the following includes information regarding a person's credit, character, reputation, and habits? This is the consumer report. Screenshot that. What is a foreign insurer? Foreign. Another state. Another state. So foreign is another state. Alien insurer is another country. Foreign, another state. Alien, another country.
Okay.
Something that helps you memorize, bro, is illegal aliens. Illegal aliens are from another country, right?
No.
My deal. Which of the following are generally not considered when underwriting groups of insurance? Which of the following are generally not considered when underwriting groups of insurance? Uh, insurance medical history groups, the nature of the group, the size of the group, not considered the group's past claims. I think it's that one. Oh, the insurance medical history. Oh, okay.
History.
Yeah, group insurance, they don't check your health. I forgot about that. Got it?
What is it?
It's that they don't check medical history. Group insurance doesn't generally check medical history.
Okay.
The main difference between immediate and deferred annuities is
This
when
one got me.
yeah,
This one's on the test, and between that one and the purchase, that's where it jacked me up.
okay, good. Did you hear that? This one's on the test. So the main
Yeah.
difference between immediate and deferred is
And
when the
that's what the
when the income payments begin.
payments.
So the income payments on immediate annuity begins within 12 months. Income
Okay.
payments on a deferred annuity begins after 12 months. All right. So you got to
Oh,
know that within 12 months, after 12 months.
yeah. I
Screen.
definitely got that one wrong.
Yeah. Screenshot that. This is good. Review. Always read. Here's a big tip, bro. When you're taking these practice as you learn as you go, especially mastering chapter 4, 5, what is the other one? 1, and then 3 and
But yeah.
so you master in California, by the way, I'm talking California, right? So if you master 4, then chapter 5, then you master chapter 1, then you master chapter 3, then you master chapter 7. When you master those, you want to study like this and read the rationale completely so that you can start understanding, oh, why that's the answer. That's why the answer is the answer. If only one party to an insurance contract has made a legally enforceable promise, what kind of contract is it?
Uh,
One party, unilateral.
That one's on the test too. We got that one.
Yeah. So one
Yep.
party, uni. Uni
Just
meaning,
one side.
yeah,
One sided.
one-sided. Yeah. Which is the appropriate action by the insured if the prospective insurer submitted an incomplete application?
This is another one that was on the test.
Return the application to the applicant for completion. I mean, that's the only common sense, obvious answer, right? All right, let's keep going. Which of the following statements is most accurate concerning the commissioner's term of office? Sirs, I think it's that one. Yeah. So 2 4-year terms is a max, like the president of the United States, the commissioner. Profitable distribution of exposure serves the purpose of profitable distribution, protecting insurer against adverse selection. B. Yeah, this one you're just gonna have to remember what, because it's all gibberish, it's all like Chinese. Profitable distribution of exposure, protecting against adverse selection. Nobody speaks like that, you know what I mean?
Yeah.
So you're just gonna have to remember that right there. Which of the following insurance options would be considered a risk sharing arrangement? Risk sharing, is it mutual or reciprocal? Mutual or reciprocal? I think it's mutual. Damn, it was reciprocal. I get them confused all the time. So it's reciprocal. When your risk sharing arrangement is reciprocal. All right. Peril is most likely defined as the cause of loss insured against. Peril is a cause of loss. An insured pays 1,200 annual for his life insurance premiums. The insured applies for a year, this year's 300 worth of accumulated dividends to next year's premiums, reducing it to $900. What option is this one? This one is a reduction of premiums. This one's easy, right? Just use common sense. Reduction of premiums is the dividend option that reduces your premiums in the future by using the dividends to pay for it. Let's see what else do we have here. Okay. What required provision protects against unintentional lapse of the policy?
We got
Grace.
grace period.
Yes, sir. Grace
That
period.
one's on the test too.
Oh yeah, grace period for sure. It's going to be on the test. A fixed annuity premiums are invested in the insurance company's general account. The guaranteed minimum interest rate 2.5. During economic times, it went down to 2. What interest rate would the insurer pay the policy? Well, it has to pay the guaranteed
I,
minimum. It has to pay the guaranteed minimum, even if the market does low. Social Security benefits are available. Surviving spouse until youngest one reaches a 16. Benefits are again available when the spouse reaches the age of 60. What is the time period called during which the surviving spouse does not receive benefits? It's called a blackout period.
that's on the test too.
Yeah, blackout period. Period of time from the 16 to 60 is a blackout period. What is the other term for the cash payment settlement options? Lump sum. Cash payment settlement options called lump sum, also known
That
as
was on the test too. I got that one wrong.
dang. The requirement that agents not commingle insurance monies with their own funds is known as the requirement that agents not commingle insurance monies with their own funds is known as fiduciary responsibility. Yeah, fiduciary responsibilities. It's the you're responsible for somebody else's money. You don't want to commingle it with your money. That's illegal, right? You could get in trouble for that.
Yep.
Circulating deceptive sales materials to the public is what type of unfair big business traffics is called false advertising. When someone purchases insurance, what risk management technique are they exercising? Purchase
Trans
insurance is the transfer of risk.
transfer.
Yeah.
That's what I always forget that one.
Yeah, people weren't jumping in the class, bro, because I have the old Zoom link. My bad.
Oh, is that what it is?
Yeah, I had the old Zoom link, yeah.
Oh, even on YouTube already?
No, no, on YouTube. This is on the Telegram chat.
Oh, okay. I thought you put it up on YouTube.
Yeah. Okay. There it is. You need anything else, babe?
No. Yesenia is gonna jump in, but she needs to register for the class.
Okay. I'll hit her up. Okay.
George,
We'll see. We'll see. See, porque I'm not done here. All right, here we go. All right, let's resume here. Okay, someone purchased, transfer. Yeah, so when you purchase insurance, you're transferring the risk.
Transfer.
Yes, sir. Transfer the risk. All right. The legal definition of person would not include which of the following? A family, because a business. Hold on. We got some we got some people that need to be muted. Let's mute all upon entry. All right, cool. So the legal definition of person would not include which of the following? A family. A corporation is a person. An individual human being is a person. A business entity is a person, but a family is not a person. A family is a group of persons. See that? All right, let's go to the next one. A universal life insurance policy is best described as variable life with cash value account. Universal life is best described as a flexible premium. Nope, not variable. Annual renewable term with the cash value account. There it is. There it is. That's a good one. This one's tricky. Hold on. Give me 1 second. Hold on, brother. All right, cool. All right, let's continue here. By the way, universal life is also known as flexible premium adjustable life. But the reason I didn't choose B is because it says variable. And right here, it doesn't say variable, it just says universal life. So I didn't choose B because flexible premium is right there. A also has the word variable, so that's out. Whole life is not universal life, so that's out. So you could even have gotten this one right by just process of elimination. You see what I mean? But universal life uses annual renewable term. That is correct. And it has cash value. Yup, that is correct. Which of the following is not allowed in credit life insurance? Credit life insurance. Creditor having a collateral assignment on the policy. Creditor requiring that the debtor has life insurance. Creditor becoming a policy beneficiary. Creditor becoming a policy beneficiary. Yeah, creditor requiring the debtor to buy insurance from a certain S is not required. So they can't force you to buy only, Primerica term or a certain type of term. It has to be flexible. I mean, they could choose wherever they want to go. Okay. Because an insurance policy is a contract between an insurer and the insured, it most conform to the state law governed contracts which require all of the following except legal purposes, counterparties conditions, competent parties conditions, acceptance conditions. There it is. Screenshot that right there. This one I don't like this question. I always have a hard time with this. But you got to know it, right? Consideration is part of the structure. Consideration is an essential part of the contract. Next one, if a life policy allows a policy owner to make periodic additions to the face amount at the standard rates without proving insurability, the policy includes a guaranteed insurability rider. Remember that? So this is an additional rider that that if the client wants to get more coverage later on and they are sick and they have this rider, then the sickness doesn't matter. They could get more coverage without being checked for medical records, being checked for their health, without being insurable, because it guarantees insurability. All right, next one. All insurance policies and annuity contracts deliver to senior citizens in the state of California are subject to cancellation period of at least 30 days. Remember that? So senior citizens, 30 days free look period is also known as a free look period. So our cancellation period, free look period, they're the same thing. Okay. Free look period, cancellation period. All right. Let's go to the next one. Annuities can be used to fund which of the following? Retirement plans, estate creation, group life insurance, variable life insurance. So retirement plans is the answer. So annuities are a savings that you could use. You could put retirement plans in it. And annuities is a type of savings. It's not really insurance. It just protects the savings. That's what the insurance part is about. So you got to know there's a big chapter on annuities. There's 8 questions on the test in California on annuities alone. So you got to really be good on what annuities are all about. When a group coverage replacement sale has occurred, which normal provision of new policy cannot be applied as usual? Beneficiary, renewability, pre-existing conditions, premium. When a group coverage replaces, which normal provision of policy owners cannot apply it as usual? Beneficiary. Dang, I don't know. This one's a good one. Pre-existing conditions. All right. So let's read out in the bottom. A replacing, this is what I would do, okay, guys? The ones you know, you know. But if you get it wrong, like right now I got it wrong, I'm gonna read the rationale because I want to get it right for the future, right? Or if it comes out on the test, boom, I'm gonna knock it out. A replacing insurer cannot refuse benefits on the grounds that the condition existed prior to the effective date of the replacing coverage. Okay. I just read it. I didn't understand what it says. So I'm going to read it again. A replacing insurer cannot refuse benefits on the grounds that the condition existed prior to the effective date of the replacing coverage. Okay. So basically it's saying that when you're replacing a coverage from one company to another, he cannot refuse benefits because the person is no longer insurable. Basically that's what it's saying. So new policy cannot be applied as usual on renewability. All right. So, anyways, good luck. Which of the following would be covered by contract law? Neighborhood suing each other for trespassing, and an employer suing an employee for spreading damaging rumors, an insurer issuing an insurance suing the insurer for failure to provide promised benefits, consumer suing the manufacturer for defective products. Okay, there it is. Don't forget to screenshot, guys, so you can keep it for your records, the screenshot part. Social Security was created to provide all of the following benefits except unemployment, retirement, disability, survivorship benefits, um, disability. I think it's unemployment. Yeah, it's unemployment. There it is. Screenshot that. Which of the following is true regarding taxation of accelerated benefits under the life insurance policy? Which of the following is true regarding taxation of accelerated benefits under the life insurance policy? They are always taxable to chronically ill insured. They are tax-free to terminally ill. Accelerated benefits, they're always taxed. They're tax-free to terminally ill insured. Ooh, okay. Screenshot that. So accelerated benefits. This is a rider that that if you become terminally ill, then the company gives you an accelerated benefit. They give you some of your face amount while you're still alive to pay for the for the health issues and stuff like that. And when you get it, you got to pay taxes on it. But right here, this is where it got me. It's actually tax free only to terminally ill insured. So if the person is terminally ill and they get money, then it's tax free. Okay. If an immediate annuity is purchased with the face amount at death or with the cash value at surrender, this would be considered the purchase of face amount at death or with the cash value at surrender. This is considered a settlement option. Settlement option. Go ahead and screenshot that so you can read the rationale later on. The rider in a whole life policy that allows a company to forego collecting the premiums if the insured is disabled is called, so the rider of the policy in the company to forego collecting the premiums if the insured is disabled is called waiver of premium. Waiver of premium. See that? So you got to understand how these are all riders right here. Payer benefit rider, guaranteed insurability rider, waiver of cost of insurance rider, waiver of premium rider. You got to understand what they are. And so by you reading the rationale, it explains what it is. I'll read this one with you guys. It says waiver of premium rider waives the premiums if the insured if the insured owner has been totally disabled for a predetermined period, which is 6 months. The payer benefit provides the owner other than the insured, and the waiver of cost of insurance is found on universal life. So you see that? So it explains a little bit about everything. All right. All right, cool. Let's keep going. Every policy of individual life insurance must include a notice of right to cancel the policy stating the specific time frame for the free look period. Once the insured has canceled the policy, how many days must the insurer refund the premiums within 30 days? Okay, so this is a tricky one because you're thinking that it's going to be C, 10 to 30 days, because you're thinking that it's asking you what is a free look period time frame. It's not asking that. It's asking when the client actually returns the policy, how soon must the insurance company give them back their money, refund back their premiums? And the answer is 30 days. All of the following information about the applicant is defined in the general information section of a life insurance application, except on the general information: occupation, age, gender, education. Occupation, yes. Age, yes. Gender, yes. It's going to be education. It has to be education. Process of elimination right there. It's a good test taking tip. Make sure you use common sense and you use the process of elimination to get the right answer. Under the Fair Credit Reporting Act, if a consumer challenges the accuracy of the information contained in the consumer or investigative report, the reporting agency must respond to the consumer's claim, defend, send an actual certificate copy, change the report. They can't change the report. There it is. Respond to the complaint. Read the rationale, okay, guys? Make sure you're screenshotting these pages right here, just like this, with the whole thing, with the right answer and the rationale, so you can read it later and study it. An insurance agent who has been in a sales slump for 6 months has decided that she will offer complimentary health insurance for the first year on every life insurance policy she sells for the next 12 months. This practice is an example of free insurance as the inducement of real property is permitted by the is permitted. No, it's not permitted. Free insurance is an inducement of purchase and is prohibited by the code. Yes. An option in purchase contract, therefore, is permitted. No, a violation of the code. Free insurance is an inducement to purchase. Okay. Look at that, man. It got me. So it was B or C, and I clicked on B, and the answer is C. Violation of the code. Keep it simple, right? No policy for which there is no separate charge can be used as an inducement to purchase or rent real or personal property. Which of the following statements concerning buy-sell agreements is true? Buy-sell agreements. Premiums are paid, are deductible by a business expense. Benefits received are considered income taxable. Buy-sell agreements pay in the event of the medical emergency. Buy-sell agreements are normally funded with a life insurance policy. Okay, I'm gonna go with D. D is the right answer. Buy-sell agreement is simply a contract that establishes what will be done with the business in the event of the owner dies. Buy-sell agreements are normally funded by life insurance policies. Which of the following information will be stated in the consideration clause of a life insurance policies? Consideration means money. Okay, so when you see the word consideration, think of money. There it is, premiums amount. See that? So it makes it easy. It makes it easy to choose an answer when you know what consideration means. And look at the premium payment. That's money, right? Not period of time, not conditions, not parties. In a beneficiary, if a beneficiary wants a guaranteed that benefits paid from a principal or interest would be paid for a period of 10 years before being exhausted, what settlement option should the beneficiary select? Okay, interest be paid for 10 years, fixed period, fixed period. Okay. So right here, the beneficiary or the client is choosing the amount of years or a period of time. That's why the answer is fixed period. Okay. If the client chose an amount of money, then it would be fixed amount. But in this case, he chose period of time. So the answer is fixed period settlement option. Which of the following statements regarding business overhead expense policies is not true? Premiums paid by are tax deductible. Business overhead expense benefits are usually limited to 6 months. Any benefits received are taxable to the business. Lapse equipment expenses are covered by the plan. Oh, okay. All right. Got it wrong. All right. So the answer is B. Benefits are usually limited to 6 months. Oh, now it happened to me. Game changer. I didn't read the complete question and it got me. All right. Broke my own rules here. All right. Let's keep going. A policy will pay the death benefit if the insured dies during the 20-year premium pay period and nothing if it occurs after 20 years. This is period certain, something period certain. Limited pay whole life. Will pay the death benefit if insured dies during the 20-year premium paying period and nothing if the period. So this is a level term. It sounds like a level term to ordinary life term. Specified age. I'm gonna go to level term. Yep, level term. So basically it's a 20-year term. All right. So a 20-year term, obviously if nothing happens after the death, then that's it. You know, the term ends. Unless it's renewable term, but that right here, they're not really getting into like the details of that. Okay. All right. Oh, thanks, Mariela. Mariela's in the house. Woo. She's a licensing expert, by the way, guys. Which universal life option has gradually increasing cash value and level death benefit? Gradually increasing cash value and level death benefit. Level death benefit is option A, right? So the cash value goes up, but but it doesn't affect the death benefit. So that's option A. All right. So go ahead and screenshot that. All right. Which of the following is a risk classification used by underwriters for life insurance? Risk classification. Which of the following is a risk class? So poor, nope. It's called substandard. Standard, yes. Excellent, no. It's called preferred. It's not called excellent. It's called preferred. And normal is not called normal. It's called standard. So right here, they're just trying to mess with your brain. There's the answer. A straight life policy has what type of premium? By the way, straight life, remember that? Straight life is also known as whole life and is also known as pure life on the test. Straight life, whole life, pure life. Don't forget. A level annual premium for the life of the insured. I like that. An increasing annual premium. Nope. Premiums stay the same. A variable annual premium. Nope. Premiums stay the same. A decreasing annual premium. No. Premiums stay the same. There's the answer. Got it. Two types of assignments are absolute and partial. No. Absolute and collateral. There it is. That's the answer. So you got to know your terms. Collateral assignment or absolute assignment. Not the other ones. Screenshot that. Last one. If the policy owner, the insured, and the beneficiary under a life insurance policy are three different people, who has the ownership rights? The policy owner. Easy. Easy peasy. The policy owner could make changes, can make moves, can change beneficiaries, can change coverages, can do a lot of things. Okay. Can cancel the policy. Policy owner has a lot of power. All right.